You want to start investing? Then this video is for you. We'll go through how to start, where to start, and when to start. Investing is easier than most people think, and honestly, everyone should be doing it. I'll also share different investing strategies because the truth is there isn't one perfect way. The right strategy depends on you. Okay, first things first, you need a broker, the place where you'll actually buy and hold your investments. If you're in the EU, one of the best options is Interactive Brokers. It's highly professional, offers access to global markets, and has some of the lowest fees out there. If you're in the US, you have plenty of great choices. Some of the most popular are Fidelity, Charles Schwab, Vanguard, TD Ameritrade, and apps like Robinhood or Webull if you prefer something more beginner-friendly. The key is to pick a broker that's safe, regulated, and has low fees, because fees eat into your returns over time. Next, you need to decide whether to invest in individual stocks or ETFs. If it's your very first time investing, ETFs are the best place to start. An ETF is basically a basket of many companies, which makes it safer and more stable than putting all your money into just one stock. Over the long run, ETFs usually give you better and more consistent returns. Now, if you really want to jump into individual stocks, you can, but here's my honest advice. Learn the market first. When I started, I went straight into stocks, and it cost me a lot of money. Looking back, I would have had much better returns if I had started with ETFs. So, for beginners, keep it simple. ETFs first. Once you gain experience and understand the market, maybe in 5 years, you can start adding individual stocks to your portfolio. All right, let's start with ETFs. If you're just beginning, I recommend going with the classic ones. Let's say your budget is around $200 per month. Here's a simple split you could follow. $75 into an S&P 500 ETF, $75 into a NASDAQ ETF, and $50 into a European ETF for diversification. Or if you prefer, you can keep the full 200 in US ETFs only. That's completely fine too. The most important thing isn't the exact split, it's being consistent. Investing every single month builds up over time, and historically, this approach has been one of the most profitable and safest ways to grow wealth. ETFs are the best option for most people because they're simple and require much less work. But let's move to the second strategy, which is investing in individual stocks. Here's the truth. If you want to pick stocks, you need to actually be interested in companies, their earnings, their future potential, and their growth. It takes a lot of time and effort. If you don't want to put in the work, please stick to ETFs, otherwise you'll probably have a tough time. So, if you do want to pick individual stocks, where do you begin? Start with sectors you understand or have extra knowledge about. Then pick a few companies from those sectors and compare them. You can look at things like the PE ratio, PS ratio, PEG ratio, revenue growth, and earnings growth. These indicators can help you figure out whether a stock is overvalued or undervalued. But remember, the overall market can also be overvalued. That's why it's smart to watch the market for a while and wait for the right opportunity. A great free tool for this is Yahoo Finance, where you can find the latest news, charts, and all those ratios for every company. If you're just starting with stocks, I recommend beginning with large cap companies. These are the giants that make up the majority of the S&P 500's movement. Hypothetically, if you can pick the 10 best companies out of the 500, you could outperform the index. Some great examples to study are Amazon, Google, Meta, Apple, Nvidia, Netflix, and Tesla. Let's say you like Amazon. The next step is to go to Google and type AMZN Investor Relations. There you'll find the company's official reports, quarterly earnings, annual reports, and even conference calls. Start with the latest earnings report. It shows what the company achieved in the last 3 months. Then listen to the conference call to hear management's perspective. And finally, dig into the annual report. Yes, it's usually 100 plus pages, but over time you'll learn where to find the most important details much faster. Here's the key. You need to repeat this process for every company you invest in, and you need to stay updated every quarter. That means checking each earnings report and paying attention to major news. Only then will you be able to make smart buy or sell decisions. And here's my personal recommendation: don't sell unless you really need the money or you find a much better opportunity. In most cases, it's better to buy and hold long term. You can even add to your positions if the overall market drops, or if the company makes a great move that Wall Street hasn't noticed yet. Stock picking is hard work, but if you love digging into businesses, it can also be one of the most rewarding strategies. So, how much should you actually invest? The best approach is to put in the same amount every single month. This strategy is called dollar cost averaging, and it helps you smooth out the ups and downs of the market. For example, in your first year, you might start with $200 every month. Then in your second year, try to increase that to $300 or $400 per month, and keep growing it as your income allows. But here's an important rule: you should always make sure your income is higher than your expenses. Once you have that gap, you can focus on two things: increasing your income and lowering your living costs. That way, you'll free up more money to invest each month. And if you want to see how powerful this really is, just check an investing calculator online. Run the numbers for 10, 15, or 20 years and you'll see the snowball effect in action. That's the real magic of compounding. Small, consistent investments turn into something massive over time. The exact number isn't as important as being consistent and improving over time. Remember, it's not about timing the market, it's about time in the market. The longer and more consistently you invest, the bigger the results will be. And that's how you start investing. First, choose a broker. Second, decide whether ETFs or individual stocks fit your style. Third, commit to investing the same amount every month and increase it over time as your income grows. The truth is, investing isn't about luck, it's about discipline. Consistency beats timing the market every single time. Start small, stay consistent, and let compound growth do the heavy lifting for you. Always remember, earn more than you spend, reduce unnecessary costs, and direct that extra money into investments. Over the years, your small steps will turn into a massive snowball of wealth. So if this video gave you value, hit the like button, subscribe for more investing guides, and share it with someone who needs to hear this. The best time to start investing was yesterday. The second best time is today. Don't wait, your future self will thank you.